Good evening, welcome to Investment 360, your show with the top investment insights from South Africa and beyond. I'm Warren Dick from Trillion Asset Management, and today we're at the Radisson Blu in Sandton, attending a conference hosted by OMIGSA. First up on the show, we're going to be speaking to Peter Brooke. He's head of OMIGSA Macro Solutions, about asset allocation and where investors should be investing and how much of their money into different asset classes. Peter, thanks very much for joining us on the show.
Pleasure, thank you.
We have a world that seems to be changing fairly quickly. If I take a step back and we go back to the beginning of 2012, the expectations around investment returns from a wide array of asset classes was fairly low, and yet at the end of the year we had a fantastic run. If we look at the total return of the all-share index and even other asset classes within the domestic market like listed property, all gave us fantastic returns. So I guess the first question I want to put to you is, what are the expectations going forward this year in terms of what returns you expect to get from different asset classes? And perhaps we can start with the domestic asset classes first.
Okay, I think in terms of looking forward, we're right to look back first. So last year, one of our biggest themes was cash is trash. And cash was the lowest returning asset class. It gave you nothing in real terms. But the lower cost of global capital caused everything else to re-rate. So despite all the uncertainty, the result of the uncertainty was policy action. Policy action reduced global interest rates, and that caused the re-rating. So what we'd said last year was bad news would actually be good news for markets. Okay. And generally, we're fairly well positioned in terms of growth assets, equities, property, but also bonds were important to own. This year, the outlook is a lot better in terms of China has bottomed and is improving, the US is looking a bit better, and the risk of Europe disintegrating has reduced. But that's not necessarily good news for asset returns, because markets have already preempted that and have re-rated in advance. So I find it hard to see the global cost of capital going lower. To put it in perspective, we're seeing the lowest bond yields in the US for more than 300 years. In Holland, which is the longest living bond market in the world, it's the lowest level ever in 500 years. So the global cost of capital has probably bottomed, which means the potential to re-rate fixed income assets is reduced. So you mentioned property. Property did a phenomenal, I think it was something like 36% last year. But its yield relative to bonds moved exactly in line. So it was around the cost of capital. Looking forward, if we don't get that re-rating, we're essentially going to get broadly in line with the yield, 6.5%, plus a bit of growth. So our expectation for long-term real returns from listed property is 4.5% real. That's down 1% from a year ago, so less expected return. Take bonds. We've cut our expected return on South African bonds down to 1.5%. But actually, I think the risk could be more like 1%, particularly if you look at inflation-linked bonds. So once again, we've cut expected returns. We find it hard to see a re-rating. So cash, we expect nothing. No real return.
So cash is still trash for 2013?
I think so, but it's not always going to be trash. We've been talking that story for 4 or 5 years, and it's been right. But at some stage, cash will be the best performing asset class. And that's really when markets get too hot and we actually have a bear market. And that will be driven predominantly by global yields spiking up, giving a sharp negative return.
Okay, just before we get to some of those asset allocation calls and expectations, you mentioned that some of the policy decisions that were taken last year which allowed the market to re-rate. Did you have anything in particular that you recall that really led to the sort of groundwork for the markets to rally like they did?
I think it must be Europe coming in and backstopping that risk. Because if Europe had contaged and broken apart, I think we would have gone into the Great Depression. So the unlimited support that was provided there was probably the biggest single key event.
Is the over-indebtedness of countries like Europe and the US still a worry, even though it seems at the political level there are agreements in place to try and right size the balance sheets and the public deficits that we've seen in those countries?
Yes, is the short answer. The excess leverage has been basically replaced. It's gone out of the banks into the central banks, but it still exists. So until that is worked out of the system, we're going to have slower global economic growth. We're still going to have austerity pressures. So for instance, the US is going to have a tougher headwind this year than it had last year. Europe's not out of the woods. But as long as we muddle through, I think it enables equities to grind higher and leaves equities as your best returning asset class. It also means it's unlikely we're going to go too hot, where we flare out on the other side with inflation coming through strongly, forcing higher interest rates and forcing a derating of equities and bonds.
Okay, so let's get into that asset allocation at the moment then. And I think just for the purposes of South Africans now who are essentially free of restraints on how much they can take offshore, let's just assume that there's obviously no constraints there. But say a person's got a substantial amount of money to invest, they've inherited some money. What's the sort of breakdown in terms of the portfolio, both locally and offshore, first of all, that you'd invest those funds?
Yeah, it's a fascinating question because there's no right answer. The truth is, at Macro Solutions, we build a range of funds from ultra conservative at real income, which is for a retired person, to ultra aggressive flexible, which can go to 100% in equity. And where your risk appetite and your requirements are will push you into the different areas. And that's really going to require a financial advisor to say, yep, that's the right spot for you. So if we look at it on a theoretical basis and say, on all of those funds, where would we be? What I would say is equity should still remain a core building block in any of your solutions, because I can't see where else you're going to get that real return. Okay. Within that, I think offshore equity looks more attractive than South African equity. And that's not a function of the currency. I think that the rand has largely done what it needs to do. It's a function of diversification, better relative risk, and I think South Africa does have a potential headwind in terms of margins from the labour unrest. So it's got a tailwind from the weaker currency, but it's got a headwind from labour unrest. I think there's a couple of other asset classes that look interesting. So you are going to need to deliver yield in this low return world. So offshore property still has a decent yield. Emerging market bonds still have a decent yield. And then cash would be the weakest. So that's your continuum in terms of different allocations.
Is there any space there in the portfolio then from an international perspective for fixed income? Aside from emerging market debt?
Yeah, so I would not own government bonds overseas. It's not going to give you a good real return. It's going to give you a negative real return, and in the long run, it has the potential to actually cause you severe pain. We're not expecting that in the shorter term, but if you do see rate normalization, the risk lies in bonds. So, yeah, the best yield on offer is property and emerging market debt.
Okay, and in terms of that yield, I mean, when you sit down and you think about the different parts within the portfolio that generate returns, what's your expectation for the yield on emerging market debt, for instance?
Look, it's running a couple of percent higher than developed market. That spread has narrowed a bit in the last year, and particularly in the last 6 months of the year, but is still large enough to generate a favourable carry. What we would prefer is to own local currency denominated emerging market debt, and that really stems from it's hard to see the big developed currencies prospering. What do you want to buy? US dollar, the yen. The yen's just, I mean, today they've written you a note saying we're going to trash the yen. Sterling doesn't look particularly strong. Europe, while out of the woods, while out of the short-term sort of frying pan, it's not necessarily out of the woods. It's still got quite a tough environment. So I think you've got the potential to capture carry and to capture some currency appreciation. I don't think that you're going to get a big re-rating driven by the yields coming down.
Okay, so is that a class perhaps South African investors are underexposed to in emerging market debt? I mean, I think we've heard quite a lot about emerging market equities, and we know that from a global perspective, that's really where the growth's taking place at the moment. But are South Africans, have they got enough exposure to some of these asset classes, or should they be thinking about taking more money offshore or investing through a fund like yours where they can get that exposure?
I would guess that most people are underexposed to that area. It's a fairly fringe area, and you're not going to put a huge amount of money in it. I don't think many of our competitors are there, and it's quite hard to access. We're very lucky at Old Mutual in terms of we've got a number of really high quality sister companies overseas. So for instance, on the property side, we've got Heitman, and then on the emerging market bond side, we've got Rogue and Acadian, both of whom run very, very good funds. So we utilize them to manage the money for us. We set up to do it. It's accessible. But for the man in the street, there isn't a standard offering of, okay, here's an easy to access emerging market bond fund.
Just turning our attention locally to the domestic equity market, you say you're seeing more opportunity offshore. Does that mean it's unlikely that markets will rally, our local JSE will rally to the same extent it did last year?
I'd be very surprised if we get a 29% return. Last year, a lot of that return was driven by a re-rating. So if you look on a historic PE price earnings ratio basis, the PE increased by 35% last year. Sorry, in terms of, let me take that back. If you look at the returns last year, half of it was delivered by earnings, 15% was delivered by dividends, and 35% was delivered by re-rating.
Right.
But on a forward PE basis, almost all of the return was delivered by a re-rating because forward earnings fell as earnings expectations were cut. So the market got more expensive. Can the market continue getting more expensive? Yes, if money flows into it. But in terms of probabilities, your probability of such a good return is reduced. And with global cost of capital probably stabilized, we're not seeing that potential for a sharp re-rating coming through. So I would definitely expect a lower return. That doesn't mean we're not going to get a bad return. I think markets can grind higher. So 12, 13% seems sensible, and maybe a bit of upside if the macro data surprises on the upside.